Breaking. Dollar hits 95 rupees. What does it mean? Let's decode. Numbers change daily, but sometimes one number matters. A dollar above 95 rupees signals more than a rate change. It shows bigger economic forces at work. 95 per dollar means the rupee is weaker than the dollar. It affects travel, trade, study costs, and government budgets. The US Federal Reserve's policy helps keep the dollar strong. Higher US interest rates attract investors and lift dollar demand. Uncertainty pushes money towards safer currencies like the dollar. For India, many forces move the rupee. India imports oil. When oil prices rise, demand for dollars rises too. Oil is priced in dollars. When prices rise, importers need more dollars to buy the same barrels, so more rupees are sold for dollars. That's why dollar demand jumps. A trade gap means imports exceed exports. India needs more dollars to pay, so rupee faces pressure. Escalating Middle East tensions sparked heavy rupee selling. High global crude oil prices raised India's import bill, pressuring the rupee. A stronger US dollar has weighed on emerging market currencies, including the rupee. Foreign portfolio investors sold Indian assets, driving dollar outflows and the rupee lower. India's import needs increased demand for dollars, further straining the rupee. Despite the fall, officials note the rupee compares relatively well amid global turbulence, but depreciation raises domestic inflation risks. A weaker rupee changes daily life. Studying abroad costs more. Imported items become pricier. Foreign travel costs rise. Exporters can gain because their goods look cheaper abroad. The Reserve Bank of India watches closely and acts when needed. With policy tools and interventions, it aims for stability. Currencies are linked across countries. Policies and geopolitics move exchange rates worldwide. Will the rupee bounce back, or will the dollar climb? Outcomes depend on inflation, growth, and policy. 95 per dollar is more than a number. Global shifts touch daily life. Subscribe for more.